As of the middle of the trading session on Monday, January 12, 2026, Chevron Corporation, trading under the ticker CVX, is priced at $162.48 per share, representing an intraday increase of 0.85% as the market continues to digest the monumental geopolitical shifts that have redefined the energy sector over the last 10 days. While most investors are fixated on the price of crude oil bouncing near the mid-60s, the real story for Chevron isn't just about the commodity price. It's about the fact that this company has effectively secured a monopoly on the most significant oil recovery effort in modern history. Most people think of Chevron as a slow-moving giant, a defensive play that you hold for the dividend while waiting for the tech sector to cool off. But the reality is that Chevron has just executed a strategic pivot that places it at the center of a massive restructuring in South America following the collapse of the previous regime in Venezuela earlier this month. While the broader market treats this as a temporary spike, the deeper logic suggests we are seeing the beginning of a multi-year expansion that could fundamentally change the company's cash flow profile. The expectation from the general investing public is that Chevron is a victim of a saturated market and falling global demand in the face of the energy transition. You'll hear analysts on television talk about how the Hess acquisition was expensive or how the Guyana dispute with Exxon was a distraction, but the reality you need to understand is that Chevron has been playing a long game that is now reaching a tipping point. By securing its 30% stake in the Stabroek block in Guyana through the Hess deal, and now standing as the only major U.S. operator with a functional, legal, and operational infrastructure ready to go in Venezuela, Chevron has built a moat that is nearly impossible for its peers to cross. The market is currently pricing in a moderate recovery, but it hasn't fully accounted for the sheer volume of heavy crude that Chevron is about to start moving to U.S. Gulf Coast refineries that were specifically built to process that exact type of oil. This isn't just a trade, it's a structural realignment of the global energy map, and Chevron is the one holding the compass. In the retail trading communities on platforms like Reddit and X, there is a palpable sense of frustration and disbelief. Many small-scale investors feel that the stock has been held back by institutional manipulation or by the constant pressure from environmental, social, and governance funds that have been shedding oil stocks for years. There's a common narrative among retail traders that the big hedge funds are suppressed the price to accumulate shares before the full impact of the South American expansion hits the books. When you look at the recent trading volumes, which have spiked to over 25 million shares on several days this month, it's clear that the smart and patient institutional capital is moving in. We've seen major positions being increased by firms like Vanguard and BlackRock, even as some retail players panic sold during the volatility of late 2025. The tension here is between the short-term trader who sees a 1% move as a reason to exit and the institutional giants who understand that Chevron's break-even price is now among the lowest in the world. Institutional activity in the options market tells a story of cautious but firm bullishness. We're seeing a significant amount of call buying at the 175 and 180 strikes for the mid-2026 expirations, which suggests that the big players are expecting the Venezuela catalyst to materialize in the earnings reports by the second or third quarter of this year. Meanwhile, the short interest has remained relatively low, as very few professional traders want to bet against a company with a fortress balance sheet and a 4.3% dividend yield that is protected by massive free cash flow. There is a quiet confidence in the boardrooms of Houston and San Ramon that is slowly leaking out into the market, and the retail community is starting to catch on, shifting from a mindset of "why is this stock so boring" to "how much can I buy before the next leg up?" This shift in sentiment is often the precursor to a sustained rally as the fear of missing out begins to outweigh the fear of commodity price drops. If you look at the daily swings we've seen recently, it's a classic battle of psychology. Last week, when crude prices took a minor dip on oversupply rumors, Chevron held its ground remarkably well. This relative strength is a signal that the floor for the stock has moved up. Investors are no longer just buying oil, they are buying Chevron-specific execution. The recent news of the capture and removal of the Maduro regime in Venezuela on January 3rd acted as a massive clearing event. For years, Chevron had to operate under restrictive licenses, maintaining a presence but unable to truly capitalize on its assets. Now, the path is clearing for a $2 billion infrastructure repair project that will allow Chevron to move up to 50 million barrels of crude to the U.S. in the near term. This is high-margin business because the refineries on the Gulf Coast are starving for this heavy grade of oil, which is currently in short supply globally. Comment below how many shares of Chevron you currently hold and whether you think the recent political shifts in South America are a temporary boost or a permanent shift in the company's valuation. The upcoming earnings call on January 30th is the next big hurdle. Expectations are set for an adjusted earnings per share of $1.54, which would be a significant drop from last year. This low bar is actually a gift for the bulls. If Chevron can show that its Permian Basin production is continuing to grow at the 27% year-over-year clip we saw in late 2025, and if they provide even a shred of guidance regarding the acceleration of Venezuelan exports, the stock could easily break through the $170 resistance level. The market often forgets that Chevron is a cash machine. Even with oil in the $60 range, the company generates enough free cash to cover its capital expenditures, its massive dividend, and still have billions left over for share buybacks. This is the gold standard of integrated energy for a reason. They don't need $100 oil to make a fortune. They just need stability and the ability to move their product. Let's take a step back and look at what this company actually does to understand why this moment is so critical. Chevron is an integrated energy giant, meaning it handles everything from finding the oil deep underground to refining it into the fuel you put in your car. Their upstream segment is the powerhouse, focusing on exploration and production in places like the Permian Basin in Texas, the deep waters of the Gulf of Mexico, the massive Tengiz field in Kazakhstan, and now the oil-rich waters of Guyana. Their downstream segment handles the refining and marketing. For years, the story was about Permian growth, but the business model has shifted towards capital discipline. They're not drilling for the sake of drilling anymore. They're drilling for profit. The 2025 acquisition of Hess was the crowning achievement of this strategy, giving them a 30% slice of the world's most exciting oil discovery in decades without having to do the initial legwork themselves. The older reports from 2024 and 2025 showed a company that was preparing for this exact moment. They spent the next 2 years cleaning up the balance sheet and integrating new technology into their operations. We're now seeing the implementation of advanced AI-driven drilling hubs in the heart of the Permian Basin, which has lowered their development costs significantly. This technological edge is something that retail investors often overlook, focusing instead on the price at the pump. But in the institutional world, a 10% reduction in drilling costs is worth billions over the life cycle of a field. This is the reality that sits beneath the surface of the daily ticker movements. Chevron has transformed itself from a traditional oil major into a high-tech energy logistics firm that just happens to deal in hydrocarbons. Looking forward, there are several scenarios that could play out. The most optimistic one involves a rapid stabilization of the Venezuelan political landscape, allowing Chevron to triple its production there within the next 24 months. If this happens alongside a resolution to the global oversupply issues, we could see the stock reaching for that $200 price target that some of the more aggressive analysts have set. On the flip side, the risks are primarily geopolitical. If the new government in Caracas struggles to maintain order, or if the transition in the U.S. administration leads to new regulatory hurdles for offshore drilling, the stock could retreat to the $150 level. However, even in a downside scenario, the dividend provides a massive cushion. For a serious investor, a 4% yield from a company with a 38-year history of dividend increases is a very attractive place to park capital while the rest of the market deals with high valuation tech bubbles. The sentiment in the online spaces remains a mix of hope and extreme caution. There's a lot of talk about media bias and how the major news networks underplay the importance of Chevron's South American advantage to push a green energy narrative. Whether or not that's true, the data shows that the world's appetite for heavy crude isn't going away anytime soon. Traders are watching the technical indicators closely. The MACD is currently positive, and while the RSI hit an overbought level of 76 last week, the recent consolidation around $162 has allowed the stock to cool off without losing its gains. This is healthy price action. It shows that there is a floor of buyers ready to step in at any sign of a dip. The disbelief from the retail side is slowly being replaced by the realization that the boring oil stock might actually be the most exciting growth story of 2026. As we wrap up this analysis, it's clear that the gap between expectation and reality is where the opportunity lies. The market expects Chevron to be a steady, unexciting income play. The reality is that Chevron is currently the primary beneficiary of a massive geopolitical vacuum that it is uniquely positioned to fill. They have the assets in Guyana, the infrastructure in Venezuela, the technology in the Permian, and the cash to fund it all. We have seen a shift from a defensive posture to an aggressive